If you're someone in your 40s, 50s, 60s looking to save for retirement, but at the same time you're trying to keep a balance on how much you're paying in taxes today, this video is going to be important for you because we oftentimes think in very short-term sequences in how we're planning for our taxes. We want to pay less in taxes this year, so we're going to kick the can down the road and pay them later in retirement when we're in a lower tax bracket, right? But today I'm here to tell you that might not always be the case. So I'm going to give you a couple reasons why, real world examples here of what I've seen. So I'll explain some of the common terms and things to think about. And then of course at the end, I'll just give you some considerations to make with your financial advisor. I'm happy to answer any questions at the end. I'll share my email. Fair disclosure, of course, this is all for financial education. Never out to give any financial recommendations or advice to someone over the internet that I don't know, okay? So fair disclosure, just education. Always speak with your tax, legal, or financial professional for your specific situation. Let's jump right into things, right? So most people focus on W-2 income today, or if I'm a self-employed 1099, ways to take deductions today. And that might not always be the right reason. So there's gonna be a strong balancing act here depending on what tax bracket you're in. Again, a conversation with your CPA or if your financial advisor, if he helps with tax planning. But the important thing to think about, and I talked about this last video, is it's not always the right option to take the deduction today. And today I'm gonna share about 4 or 5 reasons why. And I wanna just take you through a real life example here, right? So the common person, we're gonna take someone who's 45, 46 years old, it's got $400,000 built up in a pre-tax 401k. And of course, they might have a taxable account. They may even have a smaller Roth IRA on the side. They've got a house. They may have a health savings account, maybe a 529 for their kids, right? So they have the full gambit, a lot of options here for investments, but their main large asset is gonna be their house and their pre-tax 401k or 403b, 457, depending on what employment that you're in. And that can be great, right? If you're on a high tax bracket, if you're paying 32%, 35, 37%, in taxes, it might be the right idea to continue to max out that pre-tax account and push that tax liability to the future. But there's important things that I want to at least make you aware of today, because it's always good to get ahead of tax planning, right? It's always good when we put our tax lenses on, it's always good to view our tax liability from my lifetime tax bill more so than just my yearly tax bill, because it's always easy to focus on the year, right? You can look out, you can kind of see the next 6, 9, 12 months, but it's a lot more difficult to think further out. So let's get into a few of the things that I want you to think about in terms of long-term tax planning. So let's start with the statement, I'm going to pay a lower tax bracket, or I'm gonna be in a lower tax bracket in retirement. Why in the world would I pay the tax today, okay? Let's start from a top-down level, okay? Let's look at the US as a whole. We're nearing $37 trillion in debt owed as a country. Now, it's a simple math problem from there, right? There's really not much opportunity in the future for tax brackets to go down. Now, President Trump, of course, is pushing for lower tax brackets, but at the end of the day, we can't outsolve a math problem by just ignoring it. So the thing that we have to think about here is if tax brackets are relatively as low as they've been in a long, long time right now, and we have this amount of debt, the odds are, not for sure, that tax brackets will go up in the future. So that's the first thing to keep in mind, is we do have a rough amount of debt right now that we're carrying, and we have to keep in mind that tax brackets could go up in the future. But let's say best case scenario they don't, or even that they stay the same. One thing, or a few things that I want you to keep in mind here is that everyone's situation in retirement is going to look different that they currently have here. So here's a few examples that I want you to think about, is that of course in retirement, you're not gonna have as many deductions a lot of times. So your mortgage might be paid off. You don't have the same amount of credits because you don't have dependents that are depending on you, so you can't take those. It's very important to consider, a lot of times I don't have as many ways to lower my taxable income. In a previous video, I shared ways to lower your taxable income. So with a few of those moved off the table, we have to remember we don't have those deductions nowadays. So with the standard deduction, which is the amount that the government allows you to deduct from your taxes every year, being over $30,000 for those in retirements for a couple of these days, it's difficult to surpass that unless I'm someone that donates a lot of money, unless I have a lot of rental properties or some other way to reduce my taxable income. It can be difficult to do that. The other piece is fixed income in retirement. Okay, so what I'm mostly talking about here is Social Security, my required minimum distributions, and then of course if I have a pension or annuity that I'm taking income from as well. So starting at the age of 73, you have what's known as a required minimum distribution. This is just simply the government taking the amount of time, your life expectancy, that they expect you to live, dividing that, and then of course saying, hey, you owe us, or you have to withdraw this much from your pre-tax accounts like your IRA or like your 401k every single year for the rest of your life. And then of course that's going to be added onto your taxable income and of course increase your tax bill. Along with that, you have Social Security. Up to 85% of that is currently taxable if you're making over $44,000, I believe, for a couple. So a lot of that's going to be taxed as well. And then as I mentioned, if you have a pension and if you have an annuity, this is also going to add to your taxable income. So there's really this picture here that we're forming that I'm adding all of my ways of income in retirement that I don't have an option over, right? After I turn 73, I have no option to decline that I have to withdraw this money. Same with Social Security, and if I have a pension that's turned on, these are all just going to be a faucet that's turned on and I can't turn it off. And at the same time, I'm losing my deductions, right? So I have my house paid off, I no longer have kids, and I have less deductions to take. Other things I want you to consider here is if you are in a state with income tax, that's also going to be thrown on here. So we're in Texas, we don't have a state income tax, but always keep in mind that's only going to increase your tax in retirement. Another thing important to consider is capital gains are going to increase your taxable income. So lots of building blocks here that are just adding to your income. When we build our taxable income, is now we may also have to pay more for Medicare. This is what's known as an IRMA surcharge. I put it right here, it's a long word. The IRMA surcharge is essentially similar to how your progressive tax brackets are going to work as well. So if you're someone who makes over a certain amount, depending on how you're filing, you're gonna have to pay more for Medicare Parts B and D in retirement. So Part A is typically always going to be free, but those other two pieces of Medicare to get coverage for those are going to be more expensive for you depending on how much you're making. Now let's talk about a few ways around this, right? None of these are recommendations. All of these, of course, are going to depend on your personal circumstances, but let's start there. So the first is Roth Conversions. So I have an entire video on this, so feel free to watch that. But the Roth conversion option here is getting ahead of this and being proactive, right? So if I see this large cloud out in the distance, I have all of these RMDs, I'm gonna have Social Security, I'm gonna have a pension, I might even have something that I'm not expecting come my way and increase my taxable income. Then if I decide to take the tax hit today, right? And I think in that video I talk about sometimes what we look at is the valley right after retirement, right? So let's take an example of someone retiring at 62. I'm not gonna start Social Security until 67. So those 5 years represent a lower tax bracket than I've ever been in, or probably for several years. I haven't started Social Security. If I have a pension, a lot of times they'll either make you start it right at retirement or at 65, so keep that in mind. But what I'm saying here is we're in a lower tax bracket than normal. I haven't started Social Security, so if I have room in my tax bracket to then take that tax hit, I've then removed the need to take RMDs in the future. I've removed the need to take anything at all, right? I don't have to take any withdrawals from my Roth IRA unless I want to. And then of course, if I have plans to leave this to heirs, they also have that benefit as well. Again, see that video for more, but Roth conversions are something to consider here if you are worried about a large future tax bill. The second is just making sure that your assets are in the right location. Okay, and this is something I talk about a lot as well, because we always talk about portfolio diversification. If you've ever sat in a meeting with a financial advisor, we always talk about diversification, right? But asset diversification and tax diversification is also very helpful, and maybe even more helpful nowadays, because if you don't keep your head on straight here, the IRS is gonna take it off by how much they're going to take from you in retirement. Okay, so with large 401ks, the example I gave earlier, the person had a large 401k, that represents their largest tax asset. So if we think about how large these assets are going to get over the course of 20, 30, maybe even for some of you 40 years in retirement, these are going to be large tax time bombs, not only for you, but for your heirs after you retire. So we have to keep this in mind as well. So that's why having multiple accounts, okay, having a Roth IRA, having of course, your 401k or traditional IRA, having a taxable account. In the future, I'm going to release a video on the benefit of having a taxable or a brokerage account, right? Having these different types of accounts so I have different levers to pull on and have different tax rates when it comes time to need that money or pass that money on can be very helpful. And then just to kind of piggyback off that, taking the right withdrawals is another important tax strategy in retirement and something to plan on, right? So the general rule of thumb, I'm definitely not saying that I agree with this or that this is the right thing for everyone, is to take from your taxable account first, and then the very last account that you take from is your tax-free account. The simple thought there is the tax-free account, of course, you're not gonna have to add to your taxable income, and you're gonna owe no taxes on it. So you want that account to grow the largest over time, right? So there's plenty of arguments to be made for that, of course. Getting ahead of RMDs by withdrawing early from your pre-tax accounts might be said, but having a plan for your withdrawals is another important tax strategy. Finally, and one that's near and dear to us and myself, of course, is having a strong charitable plan. So if you're someone that donates to your church or a foundation that you care about, this is where we can kill two birds with one stone. Sorry if you're an animal person. This is where we can take care of our tax liability and at the same time give to charities that we care about. What am I talking about? Well, they always say a good friend never lets a friend donate cash. And the reason is cash is an after-tax asset. The government has already taken their piece of it, right? And you give it and then it's over with. But if we give an appreciated position such as a stock, such as even hard assets such as real estate, the government, of course, does not tax you for that, but they don't even tax the charity or the church that you're giving to, and then you take that cash and you can turn around and just reinvest it. So that's something to keep in mind here. Is it's better to give an appreciated position rather than cash. The second piece I'll add here is if you are someone in retirement, or even if you're someone that's the specific number is 70 and a half years old, you have the option of a qualified charitable distribution. A QCD is what that's short for. And a QCD allows you to give, I believe, up to $108,000 in 2025 from your IRA. And at the same time, when you get into RMD time, it's going to satisfy your RMDs. It's not going to be taxable, right? So there's a lot of good benefits to it. All of that with a catch that you never want to let the tax tail wag the dog, right? So you never want to do anything just for the tax benefit, because at the end of the day, you've got to give them the money. And if you weren't already planning on doing it, that can just kind of throw your plan in disarray. So something to think about there if you're someone that's already charitably inclined, okay? So those are my thoughts today, folks. Feel free to comment below if you have any questions, or shoot me an email. As I mentioned about your specific situation, would be happy to meet with you. But thank you so much, as always, for your time and for your viewership. With the fair disclosure, as always, that I advise you to speak with a financial professional, tax professional, legal, whoever you trust to speak about your specific situation, okay? So keep that in mind. But thank you, as always, and we'll see you next time.